Hey, soldiers, we've got two very noteworthy, very popular investors who are out there making predictions about what's going to go on in the stock market. The question that many are asking, the question you may be asking is, to what extent should you listen to these individuals? To what extent should you pattern your investment strategy after what they're saying? Well, let's get into it, and we're going to talk about, how much credence you should give these people, and what actually ends up working better in the long run in terms of returns. All right, Michael Burry certainly has a flair for the dramatic. Now, we all know who this is. This Michael Burry is the individual who was featured in the Big Short movie. He was played by Christian Bale, and he pretty much called the 2008 crash. He made a lot of money betting against the whole mortgage default swap house of cards. Made a tremendous amount of money and made a name for himself. The fund manager of the Big Short fame deleted his Twitter profile on Wednesday, a day after issuing an ominous one-word message to investors. That message said simply, quote, "sell," unquote. Now, look, Michael Burry has quit Twitter multiple times after issuing ominous investor-related tweets. This is not new for him, all right? This is behavior he's exhibited several times in the past. So I want you to just be aware of that and separate, the way this is being reported, the sensationalism with which this is being reported, separate that from the reality. When you go to his Twitter, it says, "This account doesn't exist." That's now the message that's displayed on his page. The investor, again, we're talking about Michael Burry, has quit Elon Musk's social media platform multiple times over the past 2 years, typically when his tweeting attracts significant media coverage and public attention. For example, Burry took down his Twitter profile in November after his criticism of Musk led the Tesla CEO to call him a broken clock. Let me stop right here. Some people are saying I'm mispronouncing Burry. Hey, you know who I'm talking about. I put the guy's picture up on the screen. I have a regional accent. You guys just have to deal with it. I didn't go to the journalism school where they rid you of your accent and make you a robot who reads teleprompters with authority on TV. That's not what this is. So you're going to have to put up with the regional accent if you want a different view of the financial news. He also left the website, that website being Twitter, in June 2021, shortly after diagnosing the, quote, "greatest speculative bubble of all time in all things," unquote, and warning buyers of meme stocks and cryptocurrencies that they were headed for the mother of all crashes. Now, look, to an extent, that has happened. If you predict something long enough, it will happen. I'm not saying that he's a Svengali, and I'm also not saying that he's a quack. I think that, I've expressed my concerns with cryptocurrencies here on the channel, quite frequently. And as far as the meme stocks, come on, man, that is totally antithetical to what we advocate here, which is doing your due diligence, fundamental analysis of stocks that appreciate over time and maybe even kick off some income in the form of a dividend, stocks of companies that produce real things that people want, okay? I know at one point AMC, the movie chain, was a meme stock. And look, post 2020, the theater business is nowhere near as hot as it was. It's got a lot of pressures, okay? A lot of people were taken out of the theater because of the whole 2020 debacle that we went through, that whole thing. We also have streaming. Okay, a lot of stuff goes straight to streaming. And then the third and probably the most significant aspect of this is Hollywood's producing trash no one wants to see. So that has done a number on theaters. So AMC was out there for a minute, turned into a meme stock, but was it really a viable long-term bet? So he's out there saying sell, okay? Sell it all. Everything's going to hell in a handbasket, sell. On the flip side, Jim Cramer, he's saying buy. Now, look, Jim Cramer, I don't watch his show. It's a little too madcap for me, especially when we're talking about something as serious as money. He's got his own little shtick. He's obviously got an audience. It works for him. But does it work? That's the question. So he's out there saying, he's in him and the market are in bull mode. Declines represent opportunities to buy on the dip. Now, it's important to understand that both of these gentlemen, Jim Cramer and Michael Burry, to a large extent, they're not talking to long-term investors. And that's who this audience is. I like to cultivate an audience that feels as though long-term investment is the best route to take toward building sustainable wealth. Jim Cramer and Michael Burry are talking to traders predominantly. People who buy and sell with high frequency, are in and out of the market, looking for differences in price so they can play the arbitrage game and, make money, at a higher frequency. Now, does trading work? Sure. It works very well at these big Wall Street banks where you got professionals committed to it all day long. High-speed computer networks that cost billions of dollars. Yeah, at that level it works. But the retail day trader, the regular guy like you and I, Dave Ramsey's company, they did a study and they found that, 97% of day traders lose money over time, and less than 1% of day traders are actually profitable. Okay. And so that's a problem. That's a big problem because our number one goal here is to make money, not lose it, right? So if you found a formula where you're a day trader and you're part of this 1%, hey, my hat's off to you. Me, I'm not built for that. I'm not ready to commit the time or the resources or the intellect to learning how to do it for odds that are stacked against me, right? So what I prefer to do is to look at companies, evaluate them fundamentally, and like I said, sit on them long term. Now, with both of these strategies, you got the short-term investment represented by day trading, you got long-term investing. And I know long-term investing seems a lot less sexy, okay? But there is a way that you can even increase your odds over and above that of, long-term gain. Now, remember, investing in stocks is one way to make money, and it's kind of a passive way. You're not actively involved in that, again, unless you're a day trader, all right? And we already talked about the odds of success at that. Now, if you look at Jim Cramer's actual track record, when we look at his track record, we can actually glean something extremely important for your possible potential investment direction. Remember, you always got to do your due diligence. So when his Action Alerts Plus portfolio was examined, they looked at it for a 17-year period from 2000 to 2017. It was determined that it underperformed the S&P 500. So during that period in question, Cramer's portfolio delivered annualized returns of 4.08%. During that same period, the annualized gains of the S&P 500 was 7.07%. So Cramer is underperforming the market. Now, part of the reason why he's underperforming the market is because he has a show every day of the week. He's out there making predictions left and right. Meanwhile, the S&P is just doing what it does. Okay. His Action Alerts Plus portfolio is something that he has to basically underpin when he goes on his show. So he can't very well claim something's going to work on the show, and then if you don't see those same recommendations in that portfolio over time, then you got to ask yourself what's going on. So how can you actually take advantage of the better performing asset, asset class, which is the S&P 500 as a whole, as opposed to looking at a actively managed set of stocks like his Action Alerts Plus? Well, simply an index fund. Okay, even Warren Buffett has talked about these index funds And indexing, in general, is going to just allow you to take advantage of what the market does. Now, sure, you will take the slings and the arrows. So this year, for example, if the S&P is down, then of course, you'd be down with it under most circumstances. Now, I will share with you an indexing strategy that does have a floor to it, and that is the indexed universal life insurance policy. Okay. Now, that type of policy, you can, link it to an S&P 500 index, and also structure it such that it has a floor of 0%. So that if the market loses, let's say 5%, you kind of stopped at, the first floor where the market took the ride to the basement. And the reason that's important is because let's just say you're walking along one day and you've got two $50 bills in your pocket and you lose one. All right. So in order to get back to where you were, $100, in terms of percentage, you need to generate 100% more on what you still have in order to get back to where you were. Now, some people might say, well, no, all you need is 50% more. No, because if you make 50% of 50, remember, you still have $50. 50% of 50 is 25. And so you're at 75. You need to make 100% of 50 in order to get back to the 100 you had. So that's kind of the situation when you crawl out of that basement from being in a market that dipped into negative territory. You've got to come back, further than the person who stopped at 0. All right. And we're all dealing with a limited amount of time. So that's why that type of structure, the index universal life with a 0% floor, becomes, a valuable asset to have in a broader portfolio. All right. So guys, there you have it. Michael Burry is out there deleting his Twitter, calling for people to sell, Jim Cramer saying buy. But at the end of the day, if you observe a dollar cost average strategy of regularly investing, whether the market be up or down, in something like an index strategy, you're not going to be buying Lear jets, okay? That ain't happening with that strategy. But at the same time, you're not going to be looking at dented foods of, Meow Mix either. All right. All right. Check out this report here. How to survive the destruction of the American middle class. There's a concept in this video that I want you to really think about as, the years go on and America looks, like it's less and less economically viable with our high interest national debt, rising taxes. Take a look at this report, and guys, I'll talk to you soon.